Welcome back. TCS, Infosys, and HCL Technologies are the top three Indian IT services companies. IT sector as a whole has delivered stellar returns to their shareholders in the year 2020. Despite their scale, these three top companies, TCS, HCL, and Infosys, have delivered 35 to 75% total return to their shareholders in the last 12 months. In this video, we will share a brief overview of these three companies. We will discuss which of these three companies have delivered the highest shareholder returns and reason for their high return performance, and how the valuation of these three companies differ and what is the reason for the high valuation of one company versus the others. If you like this video, please click on the like button and do not forget to subscribe to our channel and share this video link with your friends and colleagues. Let's first look at a brief overview of these three companies. The market cap of these companies as on 6 January 2021. So the market cap of TCS is 1145,000 crores. For Infosys, it is 546,000 crores, and HCL, it's 265,000 crores. If we look at the market cap in USD billion, it's $157 billion for TCS, $75 billion for Infosys, and $36 billion for HCL. The revenues for these three companies for the trailing 12 months ending September 2020, for TCS, it's 158,000 crores. For Infosys, it's 94,000 crores. And HCL, it's 73,000 crores. The revenues in USD billion, 22 billion for TCS, 12 billion or 13 billion for Infosys, and around 10 billion for HCL. Average operating margin of these three companies differ significantly. So the average operating margin from the year 2016 to 2020, around 25% for TCS, 24% for Infosys, and 20% for HCL. The return on capital employed is 48% for TCS, 33% for Infosys, and 27% for HCL. And the PE multiples, so they differ significantly, around 37x for TCS, 31x for Infosys, and 22x for HCL. Now let's look at the total shareholder return for these three companies in the year 2020. So if we look at the share price of TCS as on 1st January 2020, it was 2,162 rupees. The share price as on 31st December was 2,863 rupees. So the total share price appreciation was around 32%. And if we add the dividends given during this period, the TSR or the total shareholder return for TCS shareholders was around 35%. This is great, isn't it? But let's look at the TSR or the total shareholder returns for Infosys and HCL. So the share price of Infosys on 1st January 2020 was 731. On 31st December, it was 1256. So the share price appreciation was around 72%. And if we add the dividend, the total shareholder return was 76%. Huge returns delivered by Infosys in the year 2020. For HCL, the share price was 568 on 1st January 2020. On 31st December 2020, it was 946. So the share price appreciation was 67%, and the total shareholder return, including dividend, was around 69%. So stellar returns delivered by all these three companies, but the returns delivered by Infosys and HCL is more than twice or almost twice than the return delivered by TCS. So what has driven these outstanding return for Infosys and HCL? Let's try to understand this. So let's look at the performance, growth, margins of these three companies in the last 4 quarters. If we look at the year-on-year revenue growth in US dollar constant currency, we see that the growth delivered by TCS was 6.4% in Q3 2020, 0.9% in Q4 2020, and it has delivered negative returns of minus 7.8% and minus 1.7% in Q1 2021 and Q2 2021. So the growth is negative in the last 2 quarters for TCS. If we look at the growth for Infosys, Infosys growth is way higher than the growth delivered by TCS. It's 9.5% in Q3 2020. In Q4 2020, it's 6.4%, positive 1% in Q1 2021, and a positive growth of 2.2% in Q2 2021. So outstanding growth delivered by TCS. And for HCL, the growth is even higher, around 15.5% in Q3 2020, 13.5% in Q4 2020, 1.5% in Q1 2020, and slight negative growth in Q2 2021. Both these two companies have delivered high growth. If we look at the margins, TCS leads on the margins. Its margin has remained in the range of 25 to 26%. There's a marginal dip in Q1 2021, but its margin is highest. It has maintained its margins. But if we look at the margins of Infosys, its margins have increased from around 22% or 21.9% in Q3 2020 to 25.4% in Q2 2021. Significant increase in the margins. For HCL, the margin has remained in the range of 20.2% to 21.6%. Again, a slight increase in the margins. So all these three companies have seen increase in margins, a huge jump in the margins for Infosys, slight improvement for HCL and TCS, but Infosys and HCL has delivered high growth and improvement in the margins, which is better compared to TCS. And that has led to a high TSR or total shareholder returns for the shareholders of Infosys and HCL versus TCS. Now, moving to the third question. So let's look at the PE multiples of these three companies in last few years. This chart shows the PE multiples of these three companies. PE multiple is calculated as price divided by the EPS. So this is calculated on the last 12-month EPS. So we take the current price as on 31st March of each year and on 6th January 2021, and we divided it by the latest 12 months reported earnings. In this chart, we see that in the last 12 months, the PE multiples of all these three companies have increased significantly. Second observation from this chart is that the PE multiples of TCS are significantly higher compared to the PE multiples of Infosys and HCL. HCL has the lowest multiples in last few years. TCS is at the top and Infosys is at the middle. What is driving the difference in PE multiples for these companies? We know that value is driven by the operating performance of the companies. So, difference in operating performance may be driving the difference in multiples of these companies. Let's look at the performance of these companies in the last few years. First, let's look at the revenue growth. The revenue growth for TCS and Infosys is almost the same. So both the lines are close to each other. Revenue growth for HCL Technologies is the highest, but the reason for this high revenue growth for HCL is that they have made few acquisitions in the last few years. If we look at the operating margins, we see that from 2016 to 2020, the operating margins of HCL has remained in the range of 19.5 to 20%. For Infosys, the operating margins have declined from 25% to 21, 22, and 23%. For Infosys, the operating margins have declined significantly in last few years. And for TCS, the operating margins have declined a bit, but they have delivered the highest operating margins compared to HCL and Infosys. So operating margin for TCS is significantly higher compared to Infosys and HCL. Let's look at the return on capital employed. Return on capital employed is basically the return earned by an investor for each dollar invested. So if we look at the return on capital employed or the ROCE for these companies, the returns delivered by TCS are way higher compared to the returns delivered by Infosys and HCL. So TCS has delivered returns in the range of 48 to 50%, Infosys in the range of 30 and 33%, and HCL in the range of 28 to 30% in the last 5 years. So TCS leads on margins as well as return on capital employed. This is the reason why TCS multiples are higher compared to Infosys and HCL. Better operating performance is driving high multiples for TCS. And the reason for current higher multiples of TCS is that market expects TCS to maintain a similar performance gap versus peers. So what we learned in this video, we saw that Infosys and HCL have delivered high TSR in 2020 because of improved operating performance. These two companies have delivered some growth and improvement in the margins, leading to high TSR versus TCS. TCS is valued at a higher PE multiple compared to Infosys and HCL because of the superior margins and return on capital employed versus peers. We have also seen that multiples for all IT companies have increased in 2020, driven by improved performance expectations. If these companies are able to maintain the improved margins and deliver growth, then we can see these multiples to continue in future. But if the margins decline or they are not able to deliver growth, then we will see again a fall in multiples, which will be reflected in the share prices of these companies. Hope you enjoyed this session. Thank you.